Good morning, everyone.
Hi, Kapil. Good morning.
I hope I am audible to everybody. So, since we just have 8 participants right now, we will just start the session in 5-10 minutes. So let's wait for more participants. We can start. Hi, good morning once again. I think we can start the session now. So in the last session, we have started with IFRS 9 financial instrument. Okay, before we talk about this, I'll just mention what exactly the standard which covered under IFRS 9. So there are three standards which talks about financial instrument. One, IFRS 9. Second, IAS 32, right? And third is IFRS 7. So IFRS 9 talks about the all part of financial instrument, right? Whereas IAS 32 talks about majorly equity versus liability, whether the transaction is a equity transaction or a liability transaction, or the value which is sitting in the balance sheet is either equity or the liability. It also covers compound instrument, right? So we have already discussed these ones. IFRS 7 talks about disclosures related to financial instrument. The rest everything is covered here, right? Whatever we are discussing, the rest everything will be covered under IFRS 9. So in the last session we have discussed what is financial instrument, right? Anybody knows the definition? If you remember, what is financial instrument? Thanks, Kamal. Right? Does anyone remember the definition of financial instrument? Yes, guys. Guys, these things are very important, right? So I request everybody, whatever we are doing right now, please go through the same after the session. Otherwise, it will be difficult for you to remember all these, and will be difficult to revise all these things at the end, right? Because exam is not too far, right? I would say. So it is financial asset for one party and financial liability or equity for other party. So that is financial asset, right? Now we have also seen what is financial asset, what is financial liability, what is equity. That everything we have already seen, right? Anybody has any doubt in financial asset, financial liability, and equity? Later we discuss regarding what is financial liability or equity. How do we differentiate between financial liability and equity, right? So financial liability, when we have obligation to pay, it's a financial liability. When we don't have obligation to pay, means it is on my discretion. I will decide when to pay. I'll decide what to pay, right? Then it will fall under equity. We have also looked at compound instrument. Compound instruments means instruments which has both equity and liability component, right? I hope you remember all these points. This was about what is there in the financial instrument. Then we started discussion on classification, measurement of financial asset, right? We have just started classification of financial asset. There are three types of, or I would say three categories which are there. One is amortized cost. One is fair value through P&L. One is fair value through OCI, right? So these were the three categories which we were discussing. Let's quickly recall what these categories are, because we are going to continue from here only. So the first one, amortized cost. Before that, we have identified that there are three types of financial asset. First type, debt-based financial asset. Debt-based means where we will get fixed amount back. We know the amount, how much amount we are going to get back. How or what exactly it is? It is debtors, loan receivables, right? Debentures, investment, security deposits, where I know how much amount I'm going to get back, right? The second one was equity instrument, equity-based investments like share capital, mutual funds, etc. And third one was derivatives. Right? Now, how do we categorize, how do we keep these ones, these three, all three categories into these three buckets? So these are the buckets where these assets or these type of assets would get classified. Now, whenever it is in the first one, debt-based. For debt-based, we do two tests. What are the two tests? First test, what we are going to get back, right? Are we going to get back the fixed amount or are we going to get back something else? So SPPI, which we call sole principal plus interest. If we are going to get back only principal plus interest, it means I'm not planning to sell. Means either I'm going to get the principal plus interest or it will be convertible or whatever it would be. So Neha, again, right? So I am just going to this slide, which we have already discussed last time. Right? So I think you will be able to recognize it from here. If it is debt related investment, which we are discussing right now, so we do two tests. One is whether it is going to give me principal plus interest? If it is going to give me principal plus interest, it means either I am going to get back my money along with interest, or I am going to get back something else. For example, it is convertible note. It means instead of getting my money back, I am going to get the shares. When this is only principal plus interest, we call it this test is passed. But when it is convertible loan note, means I'm going to get something else, then it is failed. When it is failed, we do not move further. We take it to the fair value option. But when it is passed, we move further, do a second test. And what is my second test? Second test is business model. Whenever I invest in any kind of debt related investments, what is my intention? What is my business model? Do I wait that the money will come back along with the interest, or do I sell it to somebody else? For example, what bank does? Let's assume Citibank is today giving home loan at 8% interest rate. Tomorrow, the rate of interest goes down. Rate of interest goes to 6%. But Citibank has home loan which is given to their customers at 8%. They are at the benefit. So what Citibank has decided, they got the opportunity. They decided that this 8% interest which we are going to get on the home loan, these customers, I can sell this portfolio to some other bank and make some money out of it. Instead of holding it back till maturity, I can sell it to somebody else and make some money out of it because it is giving me some extra benefit as compared to the market. So Citibank model, there is not to hold the investment. Their model is to sell and make profit out of it. So if business model is collect and, or I would say hold back till maturity, then business model test is passed. If not, it is failed. If passed, what will happen? If both the tests are passed, then this kind of instrument are classified as amortized cost. Means if both the tests are passed and it is debt related investment, right? This is the only thing which we have. If failed, then it will move to the fair value option. Is that okay with everybody? This is something which we have already discussed. Neha, is that fine with you? And we do not judge with only one-off transaction. There may be a case that one time company might be stuck. They don't have any option. They may have to sell their debtors to somebody. That is only one-off case. Right? That is only one-off case. For that, we need to look at what is the overall business model of the company. Right? Maybe a case I am stuck. I don't have cash. Now I need money. So for that purpose, I can go to the bank and sell my debtors, right? That is only one-off case. That is not my business model. My business model is that what I do throughout the life of my business. or what is the generic business model I follow. Okay, it can change, of course. It can change. If it change, then whatever we were recognizing here, it will then move here, right? So if it is failed, we take it to the fair value. Now, what fair value is? It says if it is failed, what will you do? You then have to see whether it will go to fair value through P&L or fair value through OCI, right? Fair value through P&L or fair value through OCI. That's something we decide, and company has the option, right? They can choose whether they want to take it to the fair value through OCI or fair value through P&L. That company can choose, but once in the beginning. If they have chosen fair value through P&L, every time that class of asset would go to P&L always. If they have chosen fair value through OCI, it will be fair value through OCI every time for that class of asset. I hope this is fine, right? Now moving on to second one, which was equity investments. Now, do I have option of amortized cost for equity investments? So Neha, company decide basis that what is going to be the long-term strategy, right? I will give you one example, right? In the equity part, then you may apply the same concept to the first one also, right? Equity-based investments. Okay. Now, can you tell me, do we have amortized cost option in equity-based investment? No. Only fair value. And in fair value, we have two options: fair value through OCI, fair value through P&L. Right. Now, can you tell me which one will be taken to the fair value through P&L and which one would be taken through fair value through OCI? We have discussed it last time, right? ABC purchased 10 shares of Reliance at rupees 900. So what is the value of the shares? 9,000, right? Current value is 1,700. Now, how much is the difference? Difference is the value now today is 17,000. What is the difference? Difference is 8,000. Which is gain for the company. Now, where this gain should go? Should it go to P&L or should it go to OCI? So it depends. Depends on if intention is to trade and make short-term profit. Then P&L, no option. But if intention is to hold for long term, then OCI or P&L, company has a choice. Is that okay? Is that okay with all? Now my point is, which one company should choose? P&L or OCI? Which one could be a better option for the company? Here the gain and loss, everything would go to, right? If P&L is chosen, gain and loss will go to P&L. If OCI is chosen, gain and loss will go to. Now, how company can decide what to do? It depends on the company's overall policy. For example, company wants to show gain in P&L. They want to realize all the gain in the P&L. How much gain they will show in P&L in this year? 8,000. Now tomorrow, because the market crashed, this 17,000 became 7,000. So there is a loss. That loss will appear in the P&L. Means till the time I have those shares with me, its gain and loss will keep impacting my profit and loss account. It all depends what is my policy, what exactly I want. Do I want to show this in the P&L every year? Means my P&L will always be dependent on the value of these. Okay. So companies which has aggressive, right, policy to show the profitability in the books, they may choose that. But if company choose OCI, then the entire amount of gain and loss will keep going in OCI. It will never hit the profit and loss account. And you can understand that even the value is going up and down, it will be marked to market in both the cases, right? I have not kept any different values. Values will remain be the same. The only thing is where the gain or loss will, whether it will go to P&L or OCI, that is totally dependent on the company's, right, company strategy, right, where they want to show. So that choice company has to make initially. Okay. Is that fine with everyone? And if it is derivative generally is for the short term only, and the intention is to make the short term money. So the derivative difference will always goes to fair value through profit and loss. Is that okay with all? Right. The only thing which we just need to know is there is concept called fair value through OCI with recycling and fair value through OCI no recycling. What does it mean? I have P&L, OCI. I have invested in debentures where both tests failed. I have chosen fair value through OCI options. Purchase debentures for 1 lakh. Current value is 1,60,000. Now, if I have chosen OCI option, where the difference would go? So fair value difference in the debenture 60,000 will go here. I hope this is fine, right? On the other hand, we have equity invested 80,000 or 60,000, 80,000 in Reliance. Current value 1,40,000. So 170,000. And option chosen fair value through OCI. Where the difference will go? Difference will go here. In both the cases, difference is sitting here. But what is the only difference among these? One is recycling, another one is non-recycling. So let's assume company sold these shares for 180. How much profit company has made now in this year? How much profit company has made in this year? 10,000. So profit 10,000. So this profit will go here. No recycling means whatever was there in the OCI will never come out of the OCI. This will remain be there because the values were changing, right? And whatever values we have considered there, it is somewhere sitting in the OCI, right? It means from OCI to OCI, it may go from one reserve to another reserve, retain earning, but not come to profit and loss. Okay. But looking at this one, let's assume company sold these debentures for 190. How much profit is there? Profit is 30,000 additional. So we will say gain of 30,000 plus recycled from OCI. That is the amount 60,000 will come here and from taken out. Is that okay with everyone? So it doesn't matter, as I told you, right? We have to follow the same concept. Whatever has gone to OCI in this particular case will never come out. It will keep hitting my reserves directly in the balance sheet. But whatever has happened here, it will be reversed through OCI to P&L. Is that okay? So are we clear with recycling and non-recycling difference? So recycling concept was my gain was 30,000 in the current year. Right? My gain is 30,000 in the current year, but this is the recycling one. So I will transfer to P&L, which is this 60,000 will get transferred to profit and loss. Is that okay with all? Now thing is, can we choose recycling and non-recycling? No. If it is debt related, right? If it is debt related, investment, right? Fair value through OCI will always be recycled. But if it is equity related, fair value through OCI will always be non-recycling. Is that fine? Neha, please tell me what exactly is not clear, then we'll discuss that point. Anybody? Any question? Yes, guys. Please let me know. Then probably we'll move ahead quickly. By recycling, it means that the reserve means the point which we have created here, it will be recycled into P&L. But in fair value through OCI, which non-recycling, it means it will not come to P&L. It will go within the equity portion. Right? For example, if we have seen IS 16 property, plant and equipment, whatever gain we get from fair value adjustment revaluation, that gain never comes out in the profit and loss. What we do, we create revaluation reserve, and that revaluation reserve get transferred to the retained earning directly. We do not transfer it to profit and loss account ever. The same concept we apply here. Is that okay? So this is exactly similar to revaluation reserve. Any question, guys? Anybody? If this is clear, like we can, this is all what we have discussed so far. ABC has yes. Yes, it is. It could be fair value through OCI or P&L. It all depends which option we have to see. So logic for, okay. So here, if we talk about logic, why logic is there? As I mentioned, let's assume you have purchased Reliance shares at 800 rupees. You want to hold these shares for long time. Long time means you don't know when you want to sell it. When you don't know when you want to sell it, the gain or loss keep coming in your profit and loss account, right? There it says the value is going up or down, right? You are not taking any decision on that. Your intention is something else. For example, I have made a strategical investment in some company, right? I want this company to grow and give me a good gain in the future. So there, the intention is different. Their intention is not to make profit every year. That is the reason when their intention is not to make profit every year, why should they take this amount of P&L? Is that okay? Yes. That fair value gain, if you have taken to OCI, it will be regained. So Tejas, there they have given the option whether you want to take it to P&L or not. Reason, even if you are parking it to OCI, eventually it will come to P&L because it is recycling. Is that okay, Tejas? That is something which is very clear. Both, Vinayak, gain or loss, both will go to OCI. At the time of maturity, exactly. At the time of maturity, or at the time when you sell and realize the gain or loss. Is that okay? So whenever you realize that amount or the sale, that will always be taken to the P&L, right? Through recycling model. Fine. Right. So we have already talked about all these. I'll just take one example. ABC has given loan to PQR. Amount 1 lakh. Interest 10%. Period 3 years. Interest paid back every year end. Now, can you tell me what would be the value of this at year end 1, 2, and 3? Opening is 1 lakh. What would be the closing value at year 1, 2, and 3? Which option we are going to apply? Which model? Out of 3 which we have just discussed. So we are going to apply amortized cost. Okay. And amortized cost says opening plus interest minus payment. So interest is 10%. Payment is the same amount every year. So my closing value at year end 1 would be 1 lakh. Right? 1 lakh. It will become opening for the next year, then interest, then payment. So it will be 1 lakh every year amortized. Okay. Now if I change the scenario, amount whereas interest would be paid back at the end of 3rd year along with the principal repayment. What would be the values? What would be the values? Can you tell me? So year end 1, so opening plus interest, payment is 0. So year end 1, this would be this. It will be year on year. So we are just compounding the interest instead of charging 10% on the base value. Is that okay with all? Is everyone clear with this? So interest is 10%, period is 3 years, right? PQR will pay back interest plus 30,000 or 33,000 every year, right? So PQR will pay back interest plus 33,000 of principal amount every year. This is kind of the EMI option we can choose. What would be the option? What would be the value? What do you think? So year one, 1 lakh, interest, this payment would be 10,000 plus 33,000. So my values here are going to be 67,000. This 67,000 will become opening for the next year. Interest would be charged on 67,000. This will be 6,700 minus 33,000. So my values would be this. So again, I will pay 3,400. Rest, let's assume I am making the entire payment in the last year. I hope this is okay with you. Fine. So we are done with this one, right? Now talking about the liability portion. Present value option will come, right? Present value option will only come. I have given loan to someone. Interest is 0%. I am charging. Market rate is 10%. Loan given 1 lakh. Period 3. In the earlier example, am I charging lower interest rate? In any case, are we charging lower interest rate in any case? No. So till the time I am not charging lower interest rate from anybody, lower than the market rate, no need to apply present value concept, because the value would remain with the same. Even if you apply present value concept, value will remain with the same. In this scenario, I am not charging any interest, but market rate is 2 lakh. Then in that case, I need to see how much I paid, 2 lakh. What is the opening value which I need to see, right? So Neha, that is what I'm saying. In this scenario, it is okay. But in earlier scenarios, I have not taken different rate. You are right. The only thing is what we are saying for this one, right? But in all our earlier examples, I have not taken a different rate, right? I have considered 10% is the market rate. Now, if I take opening value 2 lakh, market rate is 10%. I am not making any payment. So values would be 220. It is this. Now the point is, are we going to get back 2,66,200? How much amount I am going to get back? We are going to get back 2 lakh only. It means the values coming here is not correct. So what should I do? So it comes down to 2 lakh. For that, I find out the present value. So let's find out present value of this. Means some option is going. So 1 upon, or I can say, how much is the value? 2 lakh divided by 1 plus rate of interest raised to power period 3. So it means the opening value instead of 2 lakh, it should be 150,262. If I apply this, then automatically the values will come to 2 lakh. Is that okay with all? So the present value concept will only come when I am charging different interest rate, whereas market rate is different. I hope this is okay with everybody. So far we have talked about financial asset. The way we have categorized or classified the financial asset into 3 categories, we need to do that for the financial liabilities also. In financial asset, we have 3 categories. In financial liability, we have only 2 categories. Or I can say 2 buckets, 2 classifications. First one is amortized cost. And here, no test required. No test required. The first one is the amortized cost. Second one is fair value through P&L. Right? Now you may say that which one goes through fair value through P&L, because it says 99.99% of liabilities will always fall under this category, right? Only few will fall under this category. Those are nothing but, let's assume I have the derivative. Now that derivative, instead of going positive, that derivative is going negative. Is that okay? And the difference of that derivative now will go to profit and loss account. This is generally the derivative related liabilities. The rest, all the liabilities comes here, amortized cost, right? And it will be very, very simple. Amortized cost again means opening plus interest minus payment. And whatever that value comes up, that would be treated as amortized, right? There I start with what I have given. Here I start with what I have taken. If I have taken 100 rupees loan, add interest onto it, minus payment, and whatever would come would be the amortized cost. Is that okay with everyone? Is financial asset and financial liability criteria or classification okay with everybody? The third one is equity, and equity doesn't require any classification. Equity is equity, and equity value never changes. Whatever you have recognized in equity on day one, it will remain the same throughout the period till the time that equity item is there. Right? I hope it is okay and all okay with everybody. Tejas, both will affect P&L. Which one you are talking about? You're talking about both categories, right? In one case, interest will go to P&L. Right? In other case, difference will go to P&L. Right. Okay. Right. Any question, guys? Yeah, Tejas, please tell me. Up to here, anybody, any question? Because this topic which we are talking, right, is one of the complex topic, right? Or I would say the most complex topic of IFRS. I asked to everybody, please look at Tejas' question and tell me, could there be any situation where we come to the closing value and that closing value still be different from the payment which we are going to make? So amortized cost is the closing value only, Tejas, right? So it means that there should not be any difference. But if still there is a difference, I give you one example, right? I had to pay 1 lakh rupees to the bank, interest 10%, payment every year I am making the interest payment. So how much interest I'm going to charge? This into 10%. Payment is the same, closing value. This is opening and this is closing. So at the end of the third year, my closing value is this. I missed making payment on 31st March as per agreement. I need to pay penalty of 20,000. So how much is the amount? 1 lakh. How much I have to pay? 1,20,000. Right. So this difference will now be treated as the additional amount which I have to pay. Is that okay? Maybe a case because of any reason government says that we are clearing 10% of the loans, right? We are writing off 10% of the loans for everybody, right? You have to pay only 90,000. May not happen, but let's assume. So then 10,000, whatever you have gained, would be amount will go to P&L. Okay, that could be the only situation, nothing else. Anyone? This is everything is amortized cost. Only thing is where this difference will go to profit and loss. Right. So any change in liability, in any case, will go to profit and loss. As I mentioned that there are only two buckets, right? Which is there. It will go to P&L, right? It will always go to P&L. If you had to give 1 lakh rupees and 1 lakh rupees waived off by the government, then that 1 lakh rupees becomes your income. The income, which is other incomes which you need to show in the books, right? What is the reason and all. Okay. Different from interest, exactly. That is not interest. Fair enough. Up to here, I hope everyone is clear. The next thing which we are going to talk about is the transaction cost. And then we'll take a break. Right? Now, transaction cost. What is transaction cost? Right? Do we pay transaction cost? Processing fees, file charges, right? Any incremental cost. So, what if there are any transaction costs which are there? Stamp duty, right? File charges, all these which we have to consider, right? Commission, right? All these which we have to consider. For example, ABC has purchased 10,000 shares, right? ABC has purchased 10,000 shares at rupees 10,000. At rupees 100. So what is the value here? Value here is 10 lakh. ABC had to pay brokerage of 1% on it. What is the additional amount you have to pay? So 1% brokerage will be 10,000. What to do with this 10,000? This is the additional cost you are incurring. What to do with this 10,000? Any thoughts? So what should be done? Where exactly we are going to take it? right? Where exactly will be taken? So this will become part of the investment. So this kind of cost which we are talking about will be added to the investment. Is that okay? Next year, value of share is 110. What would be the value? Value would be 10,000 into 110 is this. The difference would be this minus this. So this difference would be gain or loss. Now what we are doing, the transaction cost will be added, right? Tejas, I'll come to that. I'll come to that which category, what exactly we are talking about, right? We will consider that. Is that okay with all? Transaction cost on the financial asset will be added, right? Whenever the classification of the asset is fair value through OCI and amortized cost. So we have seen whenever the classification is fair value through OCI and amortized cost, we add transaction cost. So Neha, that should fall under when due diligence and everything we are considering. It comes under when we are investing in a subsidiary, associates, and all, right? So that kind of expenses where we are not sure whether we are going to do the investment or not, right? Up to that point, any amount will be taken to the profit and loss. Okay. But whereas if the value or if the category is fair value through P&L, means in any case the gain or loss has to go to the P&L. Transaction cost, transfer or charged. Is that okay with everybody? Are these two things clear to all? That goes to P&L, right? So in any M&A or in any associate, subsidiary, or any deal which we are talking about, all those will always go under profit and loss account. Why? Because those M&As and everything will not be considered here in IFRS 9. They are part of other standard which will be discussed. Is this okay with everyone? Now, if I say ABC has purchased 10,000 shares at 100 rupees, ABC has paid brokerage of 1%, but these shares are classified at fair value through P&L. Then what we are going to do? Instead of adding it here, we will take it to P&L, and here we will just have. I hope this is okay with it, right? It all depends on whether it is P&L or fair value through. I hope this is fine with everybody. We can take up some questions for this. Right? If it is financial liability, if it is financial asset, We have added except fair value through P&L. Tejas, as I mentioned, in P&L, where the difference goes to profit and loss account only in the same period. We do mark to market every time, every reporting period. So it means whatever the difference would be, eventually it's go to profit and loss. You do it today, you do it tomorrow, whenever you do it, you have to take it to the P&L, right? That is the reason. Okay. So there is no timing difference as such. It will always goes to P&L. So that is the reason fair value through P&L will always goes to P&L. Okay. Whereas if it is financial liability, again, other than fair value through P&L, it will be deducted from financial liability. Okay. What exactly it means? Let's assume, right? Let's assume I'll take the example of both. You have taken car loan. 10 lakh rupees, interest 10%, period 3 years. Let's assume the file charges and everything are all those transaction cost is 25,000. Let's assume we are paying transaction cost of 25,000. Yeah, Tejas. As I mentioned earlier, that fair value through P&L, we don't have to evaluate. It will be directly taken to the profit and loss account. Okay. Coming here, I have taken car loan 10 lakh, interest 10%, period 3 year, transaction cost 25,000. First, tell me which category of financial liability it is. Amortized cost, right? So I will find out the values for 3 years. What this transaction cost should be? What exactly is this transaction cost? So the transaction cost is the additional expense which I have to bear. Now thing is, if it is an expense, in which period I should charge this expense? In which period I should charge this expense? Right? Should I charge in the first year? No, because this belongs to the whole 3 years, not for the first. Now to charge it, what should be done? It should be done in a way that the amount which we are taking here will be spread over 3 years. So for that purpose, I would say, what is the net amount you have received? What is the net amount you have received from bank? For 10 lakh rupees loan, how much amount you have received actually? You have actually received 10 lakh minus 25. So your liability on day one would be considered 9 lakh 75,000. But you may argue that eventually I have to pay 10 lakh, not 9 lakh 75,000. So for that purpose, we need to see opening, interest, payment, and closing. Let's assume instead of EMI, I will pay back this amount of 10 lakh at the end instead of EMI. Considering I am just trying to explain what would happen to the interest and all. What is the opening liability I may have? Yes, guys. What is the opening liability we are having? How much is the interest? 10%. What is the payment? Every year I am making the interest payment. Closing, opening plus interest minus closing. So this will become closing for the next year. This will interest. How much interest I end up paying? I ended up paying the interest of 3 lakh. Okay. Now my point is, where is this 25,000 gone then? Effectively, how much amount I am paying? I am paying 1 lakh of interest every year plus 25,000, which is the transaction cost. Effectively, I am paying this much. But how much I am calculating? 3 lakh only. How would I bring it back to 3,25,000? I hope you are understanding my point. I have to charge this 25,000 to the P&L throughout the 3 years period. So it means my expense should not be 3 lakh. My expense should be 3 lakh plus 25,000, which should be 325. Okay. Now how it will become 3 lakh plus 25,000? I would say I'll take the opening. Instead of this, my opening value is 975. Right? My opening value is 975. Is that fine with all? Is that okay with everybody? Yes or no, guys? I take the opening value, which is the net amount received from the bank, which is 975. Okay. Then I checked. The amount is 292,500 of the interest. But effectively, I have to pay 10 lakh. Is it coming 10 lakh here? Is it coming 10 lakh here? No. What should I do to make it 10 lakh rupees? Sorry. What should I do to make it 10 lakh rupees? Then I would say, actually the interest which we are paying here is 10%, but this interest should also include the transaction cost as well. Right? It means the extra expense we are paying, it should be considered in the interest component only. Right? So I will just go back and see what is the interest I have charged. Interest I have charged is 10%, which was this into 10% year on year. What should I do so that Just give me 1 second. Sorry. What should I do so that one, this liability should go up and my expense should become 3,25,000. For that, I will go and apply the IRR concept. For IRR concept in the Excel, I just take the goal seek formula, right? I would say, what I need to do, right? What I need to do, this amount here should be 10 lakh. This amount here should be 10 lakh. And what exactly I need to change? I need to change my interest rate. I need to find out how much interest should I charge so that this amount become 10 lakhs. For that, I get to I think this is something which we have applied. So I was just applying the formula goal seek option. So this value should become 10 lakh by changing my interest rate. I will see what exactly should be the interest rate. Why it is not coming here? Okay, let me just apply this thing here again. So 97,500, 9,75,000 was the interest. This into 10%. Payment is payment is actually 10% on this. So basically, what exactly the interest I have to pay? A bank will not charge me interest of 97,500. Bank will ask me for the interest of actual 10%, which is 1 lakh. Is that okay? Right? Then closing values would be this. So this is the amount which we are talking about. Is everyone okay with this? So the payment, actually we have taken wrong payment here. I have taken payment of 97,500, but the formula is that instead of 97,500, will bank charge me payment on the amount I am considering in the liability, or they will consider payment on, or they will ask for the payment on the loan they have given of 10 lakh. So they will ask for the interest on 10 lakh. Now this formula will work. So this should be 10 lakh. And I have to change this 10%. So you can see the interest rate which we were charging earlier was 10%, but the effective interest rate is this 11.02%. We call it effective interest rate. So whenever we have any transaction cost included in this, instead of taking that on the day one, I have spreaded this interest cost over the period. Now, what should be the total cost which I am incurring here, including interest plus the transaction cost which is there? So the total cost should now be 3,25,000. Is that okay with all? Cash flows in the sense, Bhagwan? You're talking about that how the effective interest rate formula can be applied? IRR, yes. This should not be. The only thing is what we need to do is we need to apply the concept of this. I just give you one example. Let's assume I purchased TV, right? TV is 10,000, right? I am taking that on EMI, right? EMI which I am paying is, let's assume 1,000 per month for 12 months, right? This is including interest and the payment, right? And the interest rate which we are paying is 10%, right? And there is a transaction cost is 500. Right. So effectively, what is the loan which I have taken, right? So if I talk about, I have already paid 500 upfront as the transaction cost where I purchased the TV. So what is the opening liability I may have? 9,500. Interest which we are talking about is this into 10%. Okay. What is the payment which we are doing every time? How much is the payment we are doing every time? 1,000 every time. Now, what is the closing amount? Closing amount should be 95 plus 950 minus 1,000, 9,450. This will become opening. Sorry, this should be 1 into 1 by 12 because this is for 12 months. Is that okay with all? And so on. So you can see what is the value coming here. It means I am paying more if I consider 10%. What should be the value at the end of the period? What this value should be at the end of the period? This should become 0. To find this out, what I'll do, I'll apply the goal-seek formula. And I say that this value here should be 0. What I need to look at? I need to look at how much interest rate should be there if I need to consider. So by looking at this, we can say instead of this much amount, instead of 10%, effectively I am paying 45% of the interest. Is that okay with everybody? Neha, is that fine? So looking at these numbers, I can just apply the formula and get the numbers. This is very high. Why? Because we are paying too much amount, right? I am paying 1,000 extra every year, plus I have paid 500. So it means in total I have paid 2,500 of the interest. That is something which we are paying on 9,500. So the accounting entries would be debit interest, which is P&L, credit liability. And for the payment, it would be debit liability, credit. So 360 is this, and 1,000 is the reduction. Is that okay with all? Yes, I hope everybody is clear with the accounting entries also. Is this fine with everyone? So all these will be dependent on how much amount you are paying. Okay. Now, if I say instead of EMI of 1,000, I am paying EMI of 850, or let's assume 925. Then what will happen? Instead of this 1,000, if I take 925, what will happen? Then I have to consider the values again. That if I take this interest or this values, I can then find out what should have been the interest component here. So it all depends that how the value has been considered. You can see the still I am paying 29.75%. So it is all dependent on the values. Is that okay with all? Neha, Tejas, all? Any question, guys? Up to here? So let's take 15 minutes break, and then we'll look at that what bank would be doing at their end, and how to consider that. They just know how we are going to calculate the present value, right? You're talking about 25,000 separately. Why we are not doing that? Because initially the loan amount is higher. So I am going to charge 25,000, means I am going to charge higher amount initially. When the loan will keep on reducing, so my 25,000 value should also keep on reducing over the period. Is that okay? That is the reason. Otherwise, I have to do two values separately, which will be very difficult. Discounting is not required, Neha. Discounting is only required when I am paying less than or higher than the values which we have considered, or effective interest rate which we have considered. Yes. So Neha, what exactly we are doing is we try to figure out that what value we are. So thing is that actually this is all my expense. Discounting is required when I'm paying lower than the market rate, right? Is that okay? When I'm paying lower than the market rate, discounting only then be required. Then I see that what exactly would be the actual contribution somebody is doing. Is that okay? When I'm paying higher, right, it actually means that I end up paying higher amount as compared to the market. Fair enough? Okay. If we are paying zero cost, then you have to do the discount. I hope it makes sense. Because you are paying less than the market rate interest, then you have to do the discounting first and apply the same logic again. Right? Do the discounting and then apply the entire logic again. Okay? Tejas, exactly. But what we are doing, right? What we are doing, we are clubbing that amount within the liability or within the asset and then amortizing. So which makes our life much more easier. Okay. So let's take 15 minutes break here and then we'll join back again, right? Yeah, hi, is everyone there? Hi guys, let me know if you can start the session now. Others, please confirm. Abhishek, Amaya, Anurag, Bhagwan, Savri, Farhan, Harika, Mayank, Neha, M. Kakani, Parth. Requesting all to confirm. Okay. So currently we have seen that what happens when we take the loan. So let's look at what happens when loan is given. Specifically, right? Specifically for banks, NBFCs, how they are going to do the accounting for the loan they have given. Let's assume ICICI Bank has given 10 lakh rupees loan to, let's assume, a customer for 3 years, right? And ICICI Bank has charged, I would say, 2% as file charges, right? So effectively, how much loan ICICI Bank has given? Effectively, how much loan ICICI Bank is given? Yes, guys. So ICICI has given the net loan of 9,80,000. Right. So opening of the asset would be 980. Interest, let's assume the interest is charged 10%. So the interest would be 10%. Which is 980, right? But how much payment ICICI Bank will collect from the customer every year in the name of interest? Will they take 98,000? How much they are going to take? They will take 1 lakh. So closing would be 980 plus interest minus payment. This will become opening for next year. And now my point is, what should we do in this particular case? Will ICICI collect 9,73,000 or will they ask for 10 lakh rupees from the customer? So they'll ask for 10 lakh rupees from the customer. Again, what we need to do? We need to look at this concept once again. This should be 10 lakh. If it should be 10 lakh, how much interest bank is charging? That we can get. Right. So how much interest bank is charging? Sorry. So bank is charging 11%, which is 10.81%, which you can see here. Is that okay with everybody? Is that fine? So in the exam, you will always be given with the effective interest. So what they will do, they will tell you what is the effective interest rate and what is the interest rate bank is charging, right? So which one you have to apply here? They will always give you this, right? So we are charging effective interest rate on the interest section and actual interest rate on the payment section, right? That's something which we need to. I hope this is fine with everyone, right? What happens if the transaction is there and all those? I think we are already clear with this amortized cost and everything we have already understood, right? Okay. Now moving on further, what is derivative? Derivatives we have seen, we have already discussed derivatives. What are the examples of derivative? Derivative example would be futures, forward contracts, right? Options, etc. All these are nothing but the derivative. But by definition, what is derivative? Definition of derivative says there are three main components which needs to be satisfied so that we can recognize derivative in the books. Now, what are those concepts? It says derivative is the instrument which will have an underlying, means it is not having its own value. It is always dependent on somebody else's value. For example, if we have option value will go up and down if share price value will go up and down. Future of gold will go up and down if the gold value will go up and down, right? Future of crude oil will go up and down if the crude value today is going up and down, right? So it is having the underlying which decide the price of that particular instrument or the contract. Second, it will always be settled in the future. We are not talking about current delivery or current purchase. we are talking about that something which we will do in the future. So I am taking a bet for the future. And the third one is that there is a very minimal investment initial. If these three categories are there, if it's satisfied, the item will meet the definition of derivative. And what we do with derivative, we take it to the fair value through profit and loss account. One thing which could be important here, it says hybrid instrument. Hybrid instrument means something which we call embedded derivative. Is derivative clear to all? What is derivative? Is everyone clear with the derivative thing? How do we account for derivative? The difference in the value for derivative will be taken to the profit and loss account. Issue comes up when it is embedded derivative, which is very complex. Complex in the sense, how do we find out whether derivative is sitting in a contract? For example, A is buying 100 units of, right, 100 units of let's say laptop. Price of the laptop is dependent. Okay, first thing, A is buying 100 units laptop. Is it a derivative contract? Can we consider this as a derivative contract? No. But if I say price of the laptop is dependent on index rate of any item, right? Any share, any item, anything, right? So which we have considered here, that though I am ready to buy certain things, but the price is somewhere dependent on some other item. Now it looks like a simple transaction, but the price has been linked to some other thing. So we call these kind of instruments as embedded derivatives. Then what we need to do, we need to separate normal transaction with derivative transaction. The normal transaction would be done simply, and derivative transaction difference will be taken to the profit and loss account. Another example could be, let's assume A sitting in India, B sitting in Australia, right? So B has placed an order of 100 ton of steels, right? B has placed an order of 100 ton of steels to A. Is it a derivative transaction? Does it look like a derivative transaction? No. Payment of this would be done in Singapore dollars, Singaporean dollars. So what is happening here? A is sitting in India, B is sitting in Australia. The transaction normally should be done in either Australian dollar or USD generally, which is used by everybody, right, for such kind of export transactions. But here, the transaction is happening in Singaporean dollar. Now, what could be the reason? What could be the reason? Reason could be reason could be that either A or B both like to get the transaction or get the money in Singaporean dollar. So it means that there is some benefit or loss which is sitting in that currency. For that purpose, we say that there is some sort of embedded derivative in this. And what we need to do, we need to separate. Right? How do we separate? That is not there in the exam, right? So generally what we need to do, we need to compare if the transaction is happening in Australian dollar, what would be the price we are going to get? If it is happening in Singaporean dollar, what is the exchange rate difference both of us, may incur? So that's something would be a derivative component in this transaction. Is that okay with everybody? Yes or no, guys? Vinayak, what we have discussed so far is that there is a normal transaction. In the normal transaction, there could be a case the embedded derivative could be a part of it. Means that though the contract looks like a simple contract, but there is some sort of derivative element. Derivative element means element which has these three. Something which will be settled in the future. I am going to get the money in the future, but that money is dependent on underlying, which could be a different currency, a different rate which is available on the market. And I am not doing any sort of investment right now. I am not paying right now. I am going to pay something in the future. So that is the case we are talking about, that along with the simple transaction, there is an element which can give me extra gain or extra loss because of that particular transaction. Okay. Now, previous example, generally, yes, Anurag, we give. So I give you one thing. Let's assume A transferred goods to B. What will happen? A would recognize the transaction, right? A would recognize the transaction in such a way that A will make the payment in Australian dollars. But instead of making the payment in Australian dollars, they are making the payment in Singaporean dollars. Earlier, if the normal transaction is there, the difference would be Australian dollars to INR. But in this transaction, what is happening? The transaction, this one is happening Australian dollar to Singapore dollar and Singapore dollar to INR. It means one, this difference would be there plus this difference would be there. Otherwise, only this difference was there. Now, thing is, why we are considering this as an embedded derivative? Because of the reason that somewhere the transaction is now dependent on the price of Singapore dollar. Is that okay? So that is the reason we are talking about that these kind of instruments would these kind of transaction would result into embedded derivative. Right? if anybody doing such kind of transaction, we need to figure out that what they are planning to do, what is the motive, ultimate goal of this particular transaction. Okay. I hope this is fine with everyone up to here, right? Hedging is a separate thing. Instead of derivative accounting, we do hedge accounting there. We will be discussing that separately. I hope up to here it is okay with everybody. Now moving further, up to here we have talked about lot many things, right? Now if I just move on further, it says de-recognize. I'm sorry guys, I'll just take this one. Please allow me one. I'm sorry guys. So up to here we have seen classification, recognitions and everything. Now we are going to talk about when we are going to de-recognize the financial instrument, right? De-recognize financial instrument means de-recognize financial liability and de-recognize financial. Now, can you tell me when financial asset, financial liability will be de-recognized from the books? When I'll remove my financial liability, any loan or anything from the books? When paid means obligation discharged, okay? Or no longer, right? So I can just talk about this, right? It says cancelled, settled, expired, or repurchased. Cancelled means that I got waive off, right? Settled means I have already paid. Expired means, if you remember, we have discussed, I have a liability on the books for the advances. If the period is over, it means now I am no longer liable to pay it back, right? A repurchase means instead of giving the liability, now I have taken the liability back and exchanged it with any particular instrument, maybe converted or something else. If any of these happens, my financial liability will be de-recognized. Are we okay with this? Right? So it ultimately meaning is that liability is no longer there. Okay. But when it comes on the financial asset, now financial asset could be anything. Equity based asset, debt based assets. When those assets would get de-recognized. When those assets would get de-recognized. Same concept, similar concept. Either asset is sold or right to receive cash is expired. That is one. Second, when right to receive cash is expired, I am no longer having that right to receive the cash. Asset will be derecognized. Or I have sold the asset to somebody and control is also transferred. I give you one example here. ABC is in need of funds. They have debtors worth 100 CR. How can they arrange? How can they arrange the funds? Right? They have debtors worth 100 CR, but they are shortage of cash currently. Right? What should they do? Yes, guys. Right? One option is ask debtors to pay early. Right? Second option is taking factoring support. Right? Factoring from bank. Right? They'll go and sell those debtors. Sell those debtors means factoring. Right? I am giving my debtors to somebody and getting cash. Okay. But what the factoring company would do? Will they give me 100 crores? Right? I have debtor 100 crores. They may give me 95 crores. Okay. Is that okay with all? So 100 crore, but I have received 95 crore. What is the difference? Am I going to get the difference? Debtors of 100 gone. I have received cash of 95. There is a loss of 5. Where the loss of 5 will go? This is the factoring charge. Is this okay with all? Yes, no, guys, please confirm. Do I have any further loss or risk in this? Yes or no? Do we have any further loss or risk in this? Right? It all depends. Whether risk is transferred or not, is dependent on the type of factoring. Right? For example, there are two types of factoring where risk is getting transferred. What we call that my risk is now transferred to the bank. Right? Do I have any further risk if my risk is transferred? Do I have any further risk? No. So we call it factoring with non-recourse basis. So non-recourse basis means that whatever happens, I am not at risk. If you have given me 95, I have taken 95, 5 is the charge. I don't have any further. On the other hand, we have risk is not getting transferred. We call it on recourse basis. Right? Who is at risk here? Here the risk is with the bank. Here the risk is with me. Then in that case, what has happened? There is a debtor of 100. Right? There is a debtor of 100. Bank gave me 95. Now, whether my risk is transferred? No. Risk is not transferred, risk is with me. When risk is with me, I cannot remove this 100. When risk is transferred, I have removed 100. When risk is with me, any bad debt happens, I have to pay that bad debt amount to the bank. The collection risk is on me. So in this scenario, this 100 cannot be deleted. Then what will happen if 100 cannot be deleted? I have received 95. That also needs to be shown. So how this 95 would be shown if 100 cannot be deleted? Any thoughts? So when 95 has been received, it means the rest of the amount we have considered as loan from bank of 95, and this 95 we will give interest and consider risk and everything in it. Is this okay with everybody? Is that okay with everybody? If risk is not transferred, this will come. If risk is transferred, my debtors, my financial asset would go, right? So basically what we are saying, as the entity transfers substantially all the risk and rewards. If yes, derecognize. If no, right, asset will still be recognized in my books, and I will recognize corresponding liability if I have taken it. I hope this is okay with everybody. That's something we will discuss. If customer is due for the long term now, basically, is that customer still a good customer, or is it becoming a doubtful debt? What exactly we should do? That's something we will look at, right? I think everything is clear to all. That's something we will look at in this particular topic, impairment of financial assets. Up to here, please confirm, guys, is everybody okay with whatever we have discussed so far? Because things are not that easy. I request everyone, go back and go through everything once again. Right? What we can do before we jump onto this, because this is again a complex area, what we can do, we can take a lunch break right now, absorb whatever we have discussed so far. We will then move to this topic, because again, this is a very, I would say, a different angle which we need to apply to the impairment of the financial asset. Is that okay, guys? So we have two topics left. One is impairment, one is hedging, right? Again, we will see where we stand and then do the hedging part, because there is a lot of information, a lot of working and everything we have already considered or already done. We will see what should be done. Should we consider to do it today, or should we push it to next week? We will do one or two questions from the revision question bank rather. Okay. So let's take half an hour break and then come back at 1:15. Okay. So 1:15 will meet. Hi, is everyone there? Requesting all to confirm so that we can start the session. Guys, please confirm so that we can start. All right, I'm just waiting for others to confirm. Parth, Rinku, Ronak, Nishita, Harika, Farhan, Bhagwan, Anurag. Okay. Okay. So I think we can start the session now. Right? So the point, or I would say we are almost covered everything except two parts. One is impairment and hedge accounting. Now, can you tell me what is the meaning of impairment? When do we apply the concept of impairment? Reduction in the value of asset. And why does it reduce? Whenever carrying amount, or I can say whenever recoverable amount is lower than carrying value. Whenever we feel that we are not going to recover the amount, right, then in that case we apply the concept of impairment. Now here, that impairment we are talking about IAS 36, which is applicable to all the assets except financial assets. But here, this impairment we are talking about financial asset impairment. Now, when do you think you'll not be able to recover the amount? When do you think you'll not be able to recover the amount? Yes. When the market value is less, okay. But the market value is less for what? If you are talking about shares, then shares are always kept at fair value, which is market value. So do we need to record impairment on shares? No. Here we are talking about impairment on those assets, for example, right? For example, debtors, loan receivables, and all, where the amount has been means there is a fixed amount at amortized cost. All the asset of amortized. Something which is already kept at fair value, no need to do impairment because it is already there on the mark to market value, which is fair value only, right? So here we are going to talk about those items which are at amortized cost. Now thing is how or when we are going to impair this or when we should impair this. Or if I say when we used to record bad debt, when do you record bad debt, right? Or doubtful debt? Whenever the recovery is doubtful, right? Whenever the recovery is doubtful, then you record doubtful debt or bad debt. But IFRS 9 came up with a different approach. It says even if everything is okay, still do you think that you will be able to recover 100% of your assets? For example, let's say PNB Housing given loan of 1000 crores to, let's say, 1 lakh customers. Everything is good. Do you think that PNB Housing will be able to recover whole amount? Is there any risk? Right? It means the risk will always be there, right? Risk will always be there. It will not be every time you recover 100% of the. So when risk is already been there, it means the recovery value will always be lesser than the carrying value of the asset. That risk you always carry. So everybody knows that risk. For that purpose, IFRS 9 came up with expected credit loss model, which generally banks always follow, right? Banks or NBFCs always follow. So this model has now been made applicable to everybody, right? So it says whenever you are giving loan to anyone, assess on day one. There would always be a risk, and that risk has to be considered. Now, why this concept came in? This concept came in after 2008 recession in the market, when we have seen lot many banks were crashing, right? There was a financial turbulence, right? Because the recovery and everything was becoming doubtful. So for that purpose, IFRS 9 came up with the approach which is matched to the regulatory guidance of Basel reporting for the banks. Now, the thing is that why they came up with this approach, so the banks can always consider that what is the risk we are carrying on day one, and user will always be clear about it. For that purpose, they say that risk can be categorized into three buckets. Bucket one, which is stage one, stage two, and stage three. What does it mean if everything is going good? Stage one. When the risk is higher, means something happens and asset become underperforming. Underperforming means that people are still paying, but there are certain people, certain percentage who have started defaulting, right? And the last one is finally when it becomes non-performing, right? When it becomes a big doubt on the recovery of the asset and it has already been due, right? So these three stages has been given by the IFRS 9, right? And it is already based on the credit quality. Stage one good, stage two, little worse, and stage three is worst, right? Now on that basis, they decide what exactly should be done for these kind of assets. We will just take the example so that we will get to know that what these models are, right? Let's assume PNB Housing given 1000 crore loan. This loan will come back in 5 years time, equally every year, right? Year 1, 2, 3, 4, 5. So every year, how much recovery amount would be there? 200, 200, 200, 200. And now, PNB estimated when everything was good, means credit rating has not deteriorated. Everything is good. Things are going fine. PNB has still estimated that there is 5% chances we may not get this amount. Means 5% people will still default. Now, if there is a 5% default, how much of the risk you assume here? Right? How much do we feel that we are not going to get back? 5% every year. It means we are not going to get back 50 crores. And what is the doubtful amount? So 5%, 10 every year. Okay. So the total value is 1000. Doubtful is minus 10 every year. Is that okay? So out of 1000, we are going to receive only 950. I hope this is fine with you. Now, condition is very fine. And we are still assuming the loss of 10 crore. Right? So what exactly it means? This says the loss which we are talking about here. How should a company consider this loss? If everything is going fine, how much loss we are going to have in next 1 year? For the amount we are going to recover 200, how much will not come back? Only 10, right? So it says whenever everything is going fine and we are at stage 1, what we need to do? Only consider loss for 12 months. Means we are going to consider impairment loss of 10. So out of 1000, we will say 10 is my loss, right? So I'll just show you how this will come. Right? And the net value will come 990. In 990, whatever amount would come back. So my closing balance would be 800 at the end of the period. Is that okay? That is the net balance. And this 10 would be taken to the profit and loss account. Now, why we are considering only 12 months? Because everything is going fine, right? And when everything is going fine, we say that the losses of every year should be recognized the year which it belongs to. Are we okay with this, Tejas? Because things are fine, right? Whether the loss will happen, not happen, whatever happens, right? We are only recognizing loss for the 12 months period. That is the guidance which has been given under IFRS 9. It says because things are going fine, why should you consider the entire loss for the next 5 years in the year one itself? Right? For that purpose, instead of doing that, consider the loss only to the period which it belongs to. I hope this is fine with everybody. Okay, not okay, please confirm. Yes. So next 12 months, only 10 loss. I request everybody to please, okay, so I'll just explain again. Neha, I was saying that as per the guidance, it says whenever anybody giving loan, having debtors or anything, on day one, they know that there is a risk X% which they are not going to recover. Now that risk, everybody consider, everybody knows. Now risk is different for different countries, different region, different people, different everything. For example, they allocate the model, they make the model in such a way, if considering Delhi, considering Mumbai, what is the rate of people who are not paying back the loan, what is, as well as what is the rate who are not paying in Mumbai, Bangalore and all. So that is how they decide, right? It is the model which is completely made by the banks or the credit rating agencies. So it is done by credit rating agencies, right? They give you the number, and how you need to do this or what you need to do this number, that's something we are discussing, right? So we have just discussed, if PNB has given 1,000 crore loan and it's supposed to get back to PNB within 5 years of time, 200 crores every year. They still are that doubtful portion, which is PNB expect 5% may not come back. And we consider 5% is again allocated to each year on a equal basis, right? So we consider 10 will never come back, right? Considering everything is going good, we are in the first bucket. So first bucket says, if everything is fine, recognize the loss only and only to first 12 months, right? Means you will recognize interest income on this 1,000 crores, right? And whatever amount come back, including interest, that's something we have. Now moving on to the second year. Now we are into second year. How many years are remaining now? How many years we are left with? Only 4. So I am just removing the fifth year. We are left with 4 years. In 4 years, 800 crores has to come back. The risk is 5%, which we have assumed. But let's assume in this year, because of some reason, let's assume the housing means all the real estate companies were not able to deliver the products, and they are still facing a lot of issues. And now PNB feels instead of 5%, the overall recovery or the doubtful is 7%. Or let's assume 8%. Right? How much it was earlier? It was I would say 5% earlier. Now it has become 8%. 8% out of 800 crores. So what we assume, that this 8% will not come back. And risk condition increased. What is happening? We are now in the stage 2, second bucket. When we move into the stage 2, it says instead of recording the loss of 12 months, because risk is higher now, so now record the loss of lifetime. Whenever risk increase, the loss should go up from 12 months to the lifetime loss, and lifetime loss is 64. So out of 800, we will record the loss of 64 and we will get 736 as the amount, and this will go to the P&L. No, Tejas, we are not moving just because we are moving into year 2. We are saying because the risk is increased. Now risk can increase in year 1, risk can increase in year 2, risk can increase in year 3, risk can increase in year 4. Whenever the risk increases, we will move into the next stages. We were not going as per historical numbers earlier also. What we did, we said we will make expected credit loss model. So banks take support from the credit rating agencies who come up and say that if you are giving loan in Delhi, males, these many people may not give back the loan. For females, these many people will not give back the loan. So they have the rates for every individual, every group, every region, every city, every country, and all. So based on that, they come up with the modeling, right? Expected credit loss model, right? So now, yes. So now we are talking about, instead of recording the loss for first year or 12 months, now we are talking about the entire loss of the lifetime. Means how much amount we are not going to recover from this particular asset, that something will be considered. And we will keep charging interest on the remaining portion, right? Means we'll keep recognizing the interest on the remaining portion of the asset. Is that okay? If actual risk increases, whenever, right, or whatever, right, from A to B or B to C, right, A1 to A, means the credit rating we are talking about. When the people move from credit A1 or AA to, A plus or whatever category, then it means the rating of the people and the risk is increasing. Is that okay? That's something we are talking about. Practically, you will be given with the numbers. Practically, you don't have to calculate these numbers. Here we are just talking about that how at the back end, those modelers actually derive the numbers. Okay, this is just a simple example, but this is backed with many other assumptions. Right now, let's assume we are in the year 3 again, or let's say year 1 and 2 is fine. Now we are in last year, year 4 and 5. So 400 is remaining. Now in year 4, we believe the risk is much higher. Let's assume because of COVID, many people lost their jobs. And when many people lost their jobs, the risk is higher. It is becoming non-performing assets, means people are not paying on time, and 25% chances are there that I'm not going to get the money. The risk has jumped from 7 or 8% to 25%. Now, what is the amount we are expecting? We are expecting 400. But what is the total amount we are going to keep is 100. It means I'm going to get 300. But this 300 also, I am not going to get back here, because the interest I was getting earlier, this interest will also be lost, because when people are not paying, it means that the doubt, the amount is not coming back, plus the interest is also not coming back, right? Earlier I was saying that we will keep charging interest on the amount which is accrued. Here we will stop charging interest. It means I will bring this 300 back to the present value for 2 years. And by doing that, I would say out of 400, how much I am going to recover? Only 247. So my loss is actually 400 minus 247. So this is how the losses of lifetime would be considered. What we are saying again, we are moving from stage 1 to stage 2 to stage 3. And on those basis, we will keep recognizing, right? We will keep recognizing the losses basis, the rate, the risk they are associated. Is that okay with everybody? Does it make sense to all? If condition improves, then we will move from stage 3 to stage 2 or stage 2 to stage 1. That will decide how exactly we are going to consider this. Is that okay with all? The provision value may get it. It all depends at what is the risk we are at and how much risk we have to consider there. What is the loss we are considering there? That would decide how much of the risk is going to be. I hope this is okay with everyone. Anybody who has not understood the concept, let me know. Let me try and figure out if we have question here. So Tejas, nothing is going to happen, right? So my loss, why would I come back here? It means that whatever we were expecting will now be coming back. It is very, very hypothetical things, right? It is very, very hypothetical. Generally, it may not happen that you move from stage 3 to stage 1, right? You can move from stage 3 to stage 2. The losses will remain with the similar. The only thing is that this present value concept would be removed. You will end up coming to this one, right? So this figure of 52 additional loss, which we have considered here, will get reversed, right? Same, right? I would say same. That again, once the risk has been increased, right? It means technically it should not come, right? Even if it is coming back, whatever losses we are having, that losses will get reversed. So whatever losses you have recognized here, that losses will get reversed and you will only recognize the loss of stage 1. Actually, the opposite entry of what you have recognized. Just allow me 1 second. Let me close the door. Just give me 1 second. Is that okay, Tejas? No. So we will only add on, right? In earlier cases, what we have done, we were keep recording it in 4th year, sorry. So loss of 4th year would be whatever loss you have recognized in year 3, right? Minus 64, right? So my actual loss in year entry for year 4 would be this. Okay. So my entry will not be means I will not going to recognize the same amount again and again. So it means whatever amount I have already recognized in year 2, the balance amount will be recognized in year 3. Okay? Let me just figure out. Okay. Please go through this one. And suggest what is to be done for this. The hedging portion we will do in the next session, right? That is again half an hour thing. I can do it today, but I think we are already having so much of information with us. Please do this question. So what exactly do you think it is? We need to account this convertible bonds in the books. Yes, everyone. How we are going to record this? So what kind of instrument it is? What kind of instrument do you think it is? It's a liability. It's a hybrid. We call it compound instrument, right? So what exactly it is? There is a convertible bond. Right? Convertible bond, 50,000 of $20 each. Right? Interest rate is 5%. Whereas market rate has been given 7%. Okay. So what we need to do, we need to figure out that how this is going to be recorded in the books. So we will say what is the period they have mentioned, after how much period they are going to do this. So January 2001, right? December 2001, December 2002, December 2003, and December 2004. So 4 years. We are going to consider how much value, how much amount we are going to pay every year, 250. Plus at the last year, I will pay this plus 100 crore. I will bring it down to the present value using 7% rate. 1.07 raised to power 1 for first year, 2 for second year, 3 for last. Right. So this is the amount of the portion which we need to, right, which we need to pay back. It should be 25. Or the value is that okay with all? So this is the liability portion for this instrument. What would be the equity portion? So the equity portion would be this minus the liability. Is that okay with all? Now, if it is okay with you, what we need to see, this was issued here 2001, but when we are doing accounting for this, are we doing accounting for a particular period so that we can record it accordingly? So it says we are doing accounting for 31st December 2001, 1 year after. Now, after 1 year, can you tell me the value of liability and equity? What would be the value of liability and equity? I'm talking about after 1 year, not at the end of third year. Now, can you tell me which category this liability belongs to out of these, out of two? Which category it belongs to, which classification? So Sampath, I am talking about, yes, it will be kept at amortized cost. Now, what is amortized cost? Opening plus interest minus payment. So opening is known to me. Interest is 7%. Payment is 25,000, which we have already seen. So what would be the value? Value at the end of year one would be 88,910 for this, and this interest will go to P&L. What would be the value of equity after 1 year? What would be the value of equity after 1 year? What we have seen, what we do with this? Do we have any category for equity? We have discussed classification of financial asset and financial liability. For equity, we have not discussed because equity never changes. Equity will remain be the same. Is it okay with all? Any question, guys? Okay. So now I request everybody, please go through whatever we have discussed so far. Try and do a couple of questions from the revision question bank. Yes, Neha. I need to see what is the full overall loss for the period. Only then I'll be able to find out what exactly is the value, right, for the next 12 months. Is that okay? Right. One thing I just forgot to mention here, we have talked about loan receivables, but what about debtors? right? For debtors, it says no need to apply 12 months or lifetime concept. For debtors, always apply simple approach. Simple approach says recognize entire lifetime loss. Okay. Loan given 100 crore. We are expecting the loan in EMIs. So let's assume over 10 years. Let me take 10 years instead of taking 25 years. So what would you do? How much amount you are going to get back every year? Right? 10 every year. Let's assume the doubt is 2% will not come back. So what is the doubt? Doubt is this into minus 2%. Right? So this is the amount you may not get back. Now, how much loss, if everything is good, how much loss you are going to recognize? Out of 100 crore, how much loss you are going to recognize? Again, this 2% everything is given by, right, is given by who? Right? The modelers, not me. What is the loss we are going to recognize if we are at stage 1? In stage 1, do I need to consider the entire loss? No. How much we are going to recognize? 0.2, which is for the 12 months only. Okay. Is that fine, Neha? Any moment I move to stage 2, let's assume after 1 month, I move to stage 2. I recognize 0.2 loss, but I realize these loss should be 2. Complete 2. How much extra loss I'm going to recognize in year 1 itself? 1.8. I hope this is okay now, right? So in P and I already have 2 on day 1. I am adding another 1.8 loss in the time whenever I get to know about that we are moving from stage 1 to stage 2, right? Whenever the credit risk is increasing. Neha, is that okay with you? So if it is debtor, right? If it is debtor, let's assume I have debtors of 500 crores. Now, generally, debtor is received in how much period? What could be the period of these debtors? Maximum 1 year, right? No, if it is the trade debtors, then I have to consider the simple approach. Simple approach says if it is for 25 years, recognize the entire 25 years if it is debtors. If it is not the loan receivables, if it is trade debtors, recognize the entire loss in the first year itself. But you may have to consider the present value because on debtor you may not be charging the interest component. Is that okay, Neha? This is right. This is going to hit. That is the reason we say that what exactly we need to consider when the debtors are getting doubtful and all those, that model now needs to be made very, very careful. Again, everybody, please, I think we have just discussed this thing. If it is debtors, no need to do anything. Recognize the entire loss in day one itself, right? We are not going to do year one, year two, year three, and so on. We would say I have 500 crore of loan. How much I may not recover back? That amount we consider on the loss itself. Yes, of course. Means whenever it is spread over 25 years, it will be 5%. Now, thing is that when you are talking about PPAs, we first need to understand, are we considering the entire amount as my debtors? That is the reason, right? So till the time it is not debtor, then why you are considering the loss? I hope you understand. Here, till the time it is not becoming your debtor, why you are considering loss in that case? Right? Because it is just the PPA, right? This is going to come over the next 25 years, which you might have entered with the government or with anybody, right? So here I'm talking about till the time it is not the debtor for you, right? So generally that is one of the reasons the debtors are always being considered on within 12 months period, right? Maybe recovery within 12 months period. So within 12 months period, we consider the lifetime losses, even if my debtors are going beyond 12 months. Okay. Is that fine now? Right. Neha, I don't know like whether you have understood or not, but I have to keep my debtors, my revenue has to be recognized only then I am moving under this particular standard. If my revenue is not recognized, I am still at IFRS 15. IFRS 15 says recognize revenue only and only when you are clear whether you will be able to recover the amount. Is that okay? Because if you remember, we have seen we make upfront assumption whether I'll be able to recover that amount or not. Only then revenue would be recognized, right? So once revenue is recognized, then we move into this particular topic. Vinayak, again, right? I think everybody is saying no specific info on recovery of debtor. Who will give the information of recovery of debtor? There is no bad debt provision anymore. Here we are talking about bad debt used to happen when you get to know somebody is in trouble. When you get to know your debtors are getting overdue after 6 months, now you should write them off. You are not waiting for that period. It says from day one itself, see what are the chances you are not going to get back the amount. From day one itself, you will keep recognizing the losses. On day one, the chances may be 5%, right? Which includes everything. People who are going overdue, people who are within 0 to 30 period, people who are within 30 to 60 days period, all those. Is that okay? So let's assume I have this. Now I allocate risk. Risk is that here my risk is only 3%. Here my risk is 5%. Here my risk is 10%. Here my risk is, let's say 12%. Here my risk is 19%. And this is 100%. So now I need to allocate how much of this amount will not be received. Right? This is the total amount. This is the amount which is not expected to receive. What is my impairment loss in this case? What is my impairment loss on debtors? Right? So my net debtors would be shown as. Is that okay? Right? This is the model which this will be booked to P&L. Yes. So you get to know about this from 0 to 30 days. From my past records, from my current customer base, from everything, I get to know that what is the percentage we don't receive from this particular lot, from this particular lot, from this particular, and so on, right? And on that basis, I recover my, or I record my losses. Okay. Now, this is again, this is based on the estimation. I may incur extra loss. I may receive more amount. That will be, adjusted going forward. That will always happen. This is not the easy task. Assumptions are very hard, right? Accounting doesn't derive assumptions. As I said, the assumptions of loan recovery is not derived by the accounting. It is derived by the modelers who will say that what is the ratio of male people sitting in Delhi not paying? What is the male people sitting in UP not paying? It will always be different. And based on the numbers which we are talking about, based on the past data, future weather expectation, future other expectation, all those things would be considered together to come to this conclusion, right? So this number will always be the number which is agreed between both you and the auditor, right? Then you will recognize the impairment losses accordingly. Okay, I think I am able to explain this thing. Vinayak, exactly. When I get to know that this is also not coming 100% tomorrow, that was my assumption. But if I get to know something is not coming additionally, that will be additional loss. Okay. So someone gone bankrupt, someone has filed bankruptcy or something like that. Right? So guys, we are done till here. We have hedge accounting to do, which we'll be covering in the next session. I request everybody, please, impairment of liability, there is no concept of impairment of liability. I have to pay. And liability, I always consider at full. Not really, Tejas. Everything has to be followed by a followed by a model, right? Yes. Means you have to make such a model to make sure that you are recording everything correctly. If any specific debtor is coming here, that may fall into different categories, right? From one place to another. So Vinayak, if you receive money and they are not asking back, right? I think so. One thing which we need to apply, we apply the concept of government grant, and government grant says when you receive money from government and you don't have to pay it back, you receive this as an income, right? So what you will do, you will do the same thing. Customer paid the money and you don't have to pay it back. You treat this as an income. Okay. Thanks, Rana. Right. So please go through whatever we have discussed so far, because that is very important. Okay. All right, guys. Thank you very much, and we'll see you next week then. SPPI was principal plus interest, sole principal plus interest, which we have learned in financial asset two test, right, which we discussed. Business model test and SPPI test. Okay. All right. So thank you, guys. We'll see you next week then. All right.